Okay. So, good evening, everyone. My name is Denisha McDonald with Financial Education Associates. I truly thank you all for joining us tonight to learn more about the various affordable loan products that are available to you guys as first-time homebuyers out there. Because you live in Massachusetts, you are blessed. Doesn't feel like it sometimes because home prices are high, but there are a lot of first-time homebuyer, low down payment assistance programs out there to help make homeownership more affordable to you. And compared to what others across the country have, you guys have some of the best products available. So I will say, of all the places to live, Massachusetts is top when it is thinking about homeownership and having resources available to you. Okay. Tonight's session is being recorded for those who are unable to attend, and also for those of you who may say this was a lot of information, I need to watch it one more time. So we will have the replay. We'll send that out to you guys after the session. You'll get an email with the replay and resources. Financial Education Associates is a HUD housing counseling agency. We provide an unbiased perspective of the home buying process to make sure you are educated and can make informed decisions going through your process. Okay, so if you guys need to take your first time home buyers classes, we do offer that. If you need to take a landlord course because you're thinking of becoming a landlord, we do offer that as well. All of our classes are virtual, so they are online. We've graduated over 20,000 people to date. And we try to make sure that you are well informed through our 8-hour course, which is the requirement to receive your certificate, but also these additional supplemental sessions so that you guys can dive a little bit deeper into certain things. Okay. So tonight we're going to be talking about the going through the mortgage process and what do lenders look for. We have Leader Bank with us tonight. We have Kathy Wentworth. And she's going to be breaking down from a lender's perspective, this is what they look for in a buyer, right? So we want to make sure you are thinking like the lender before you go speak with them. So you start getting all of your documents and your files in order so you can speak with them, okay? And then we'll also have some links that I'll provide to you guys after the session about the various down payment assistance programs available across the state. I've been collecting a list, contacting all of them to see who still has funding to date. So you guys will receive that list. It is a living document, which means it's going to change as we know more. We'll update the document. So you'll see those updates in real time. But so that you are aware of which towns have down payment assistance and how you qualify for them. So you're not missing out on money. Okay. And here's just a list of what you will get after this session. So you will get this PDF, which lists all of the documents that you're going to need and some helpful resources. You'll get the list from Kathy, whatever she wants to provide to you guys. You'll get the replay list. You'll get Kathy's contact information. And then we'll also share the link for you guys to register for your first time homebuyers class. So without further ado, I am going to turn it over to Kathy. She is our lending partner, the expert for tonight to give you guys the 411, as we say, in terms of what lenders look for so you guys can get pre-approved for a mortgage. Thank you, Kathy.
Thanks, Tanisha. Hi, everybody. So excited to be with you on this Thursday evening, and congrats to you to taking the step to increase your knowledge on the most important purchase of your entire life. So I've put together some slides for us. We're going to stop a lot for any questions. It's a small group, so feel free to put any questions you have in the chat, or if you want to raise your hand. Do they have the raise hand function, Tanisha?
Yes.
Okay, so if you want to raise a hand or something, we can always stop and answer your questions as we go along. So I'm going to focus on a couple different things this evening. First and foremost is our mortgage program options. We do have some excellent choices here in Massachusetts. I am licensed in all 50 states, and I'm very familiar with at least the New England, Rhode Island, and New Hampshire, and they have nothing compared to what we have in Massachusetts. So if you're thinking of buying in Massachusetts, you have access to a lot more than some of our neighboring states do. So I'm going to share my screen and put my slides up. And everybody can see mortgage program options, right, Denisha?
Yes, ma'am.
Okay, great. So you're not seeing that black box, are you?
No.
Okay, good. I'm seeing the share screen thing. Okay, guys. So the two most popular programs available for first-time homebuyers in Massachusetts are MHP and Mass Housing. When I'm pre-approving a client who's a first-time homebuyer in Massachusetts, my first stop are always these two programs. First is typically MHP. Okay, so the MHP1 program in the state of Massachusetts has a lot of extra bells and whistles, a little bit more than Mass Housing, comes with the discounted rate, can come with some additional grant funds we can put towards down payment and closing costs. And then Mass Housing is a great option as well. So Mass Housing first time home buyer program, you can purchase a home, a single family or a condominium with as little as 3% down. And that 3% is 3% of the purchase price. So for example, if you're buying a condo or single family, that's $500,000. 3% down would be $15,000. A multifamily home requires a little bit more. So if you're thinking of buying a multifamily and starting off being an investor and getting that rental income from the other unit or units, which is always a great opportunity if you can find one in the state of Massachusetts, that's not $2 million. But they do exist, and I do a lot of them. That particular, when you're buying a multifamily residence, it does require 5% down versus 3% down. There's credit score requirements you'll see for all programs. So when you're looking at a credit score for a single or a condominium, that score for these programs is 640. And when a lender's looking at your credit, and I dive a little bit more into this later in the presentation, you have three bureaus that report your credit: TransUnion, Equifax, and Experian. And there's three scores, and every lender, because that's what Fannie Mae and Freddie Mac and the various people that give us guidelines that we have to follow, we use the one that's in the middle. And if there's two of you on the loan, we're going to use the lower of the two. Just kind of a fun fact there. There's reduced PMI options available. PMI stands for private mortgage insurance. So depending on the program, if you put down less than that 20% down payment, there's going to be a little factor. Well, it depends on credit and other things, but there's going to be a portion of that mortgage payment that is going towards private mortgage insurance, otherwise known as MI, PMI. Mass Housing is neat in the fact that it comes with down payment assistance. Mass Housing's down payment assistance is in the form of a second lien. So you've got your first mortgage you get, but they will give a second mortgage that will help you to put towards down payment and closing costs. And you can use that to put towards the 3% down or the 5% down on the multifamily. They have two different options. Depends on your income. A lot of these programs are related to household income or to whoever's going to be applying for the mortgage, their income and whatever limits there are. With the Mass Housing program, if you happen to fall within the 60% area median income, they will give you a second mortgage for down payment assistance of $30,000 with a interest rate of 0%. And that will become due once you refinance or sell the home. If you're in the 80% to 100% AMI, excuse me, they have a second mortgage option that's $25,000, which will come with either a 2 or 3% rate and has a payback period of 15 years. So that payment can either be $172 or $160 or $172, depending on it's whether 2 or 3%. So that's kind of the fun stuff about mass housing. Next is the MHP loan program. Again, this is my first stop. I like to say my first stop on the bus. And the reason why is MHP offers a discounted rate. It will take whatever the standard 30-year Freddie Mac rate is for the week, and every lender that offers this has to discount it by 30 basis points. So right off the bat, you're getting a discounted rate with this program, okay? There are income restrictions, and they count household income as well. Depending on the mass housing has like 5 different programs. Some of them will count household, some of them will just be based on the applicant on the mortgage. But on MHP, they're going to take into consideration everybody in your household. So even if you're a couple and only yourself is going on the mortgage, your spouse or partner, if they have income and they're not going on the mortgage, that gets counted towards the compliance income. And the more people in the household, the higher the income limit. So if you've got a child, right, that's in school and working, their income wouldn't count towards this total income limit, compliance income limit. The requirements with MHP down payment is 3% on singles and condos, same as mass housing, and 5% down on a multifamily. And gifts and grants are allowed. So the only requirement with the MHP program is that you have 1.5% of your own funds. So that's pretty cool. But the thing to keep in mind on this part is that the 1.5% has to come from your own savings. You can't have it gifted to you. So if you don't have 1.5% saved today, you want to work on getting that saved so that in a couple of months when you're ready, you'd be able to apply for this program. And I'm happy to be a resource for anybody on the side note. If you like ever just want to run through some high level numbers and just see what, what might work for you today or what you might need to do to become mortgage ready, I'd be happy to speak to any of you offline. There's no private mortgage insurance with the MHP program. So there's another benefit, right? So we've got the discounted rate, we've got no PMI. If you're under the 80% area median income limit for your household, they'll also give you an interest rate subsidy for the first few years. So if the rate that I'm locking you in today, for example, is 4%, they may only charge you 3% for the first 4 years of the loan. The important piece to know is MHP is only available to a limited amount of lenders or institutions, banks, whatnot, in Massachusetts. So when you're looking to connect with a lender, it's very important to ask whether or not they have access to mass housing and MHP, because those are the 2 state programs that come with the most perks if you're buying in the state of Massachusetts. And a lot of lenders, national lenders, they don't have access to it. And they're just going to throw you into a program with no down payment assistance, with no discounted rate, and you wouldn't know the difference. But because you're here tonight, we're arming you with these tools so that when you talk to lenders, you know to ask these right questions so that you know that you're getting a full breakdown of all of the options that are applicable to your scenario.
Awesome. Can I interrupt for a second or
Of
interject?
course you can.
Okay, so clarifying questions. I think people, they're thinking it, but they're not asking it. What is area median income? What does that mean? I heard 60%, I heard 80%, I heard 100%. What does that mean?
Are you asking me that question? Yes.
Yes.
Okay. So, well, the area median income is set each year for a household. So, for example, let me bring up my MHP income limits that I trusty have available to me all day long because I'm
I
always
know. We
checking to
always have
see.
it handy.
Hold on one second. Where did it go? Income limits 2025.
And while Kathy's looking up the numbers so you guys can see, your area median income would be where they look at the income for households in a region and they take the person making the least amount of money and they line them up to the person making the most amount of money and they take who's in the middle. So who's halfway between the least and the greatest, that's the median income is what they're going to use. So you're either a percent above that, below that, or right on that number. Okay. So just giving you guys an idea of what it means. And now you get to look at what those numbers actually translate to for where we are.
All right, I'm going to throw this in front of us for a quick second.
Yes, I see it.
All right, so this is for Suffolk County, okay? And these are all of the different zip codes or cities that they consider in Suffolk County, which is Boston, Chelsea, Revere, and Winthrop. So if you're a household of one, the 80% income limit is 92,650 up to 100% of 115,800. And as you can see, as your household size increases, these limits increase. So if you're a household of three, and your total income for the household is under $119,100, then you would qualify for the MHP program with a discounted interest rate and also likely some of that subsidy I just talked about, where you kind of get that teaser lower rate for the first several years. Okay.
Awesome. So do you guys understand that? So that's not something that you need to know off the top of
Oh,
your head
no,
in
no,
great
no.
detail right now. We just wanted to give you an idea because when you're talking to lenders, when you're ready to get a pre-approval, these are two loan products you definitely want to inquire about because like Kathy said, not all lenders offer them. And if they don't offer it, they're not going to tell you about it because they don't have it, right? They don't want you to go somewhere else. So we want you to keep the one mortgage and mass housing in mind when you are going to speak with lenders because you want to know if you qualify for these programs, right? Because there's down payment assistance tied to them, there's lower interest rates, there's lower PMI or no PMI, private mortgage insurance tied to it. So you want to know those things going into when you're planning to interview lenders, okay? Um, and someone asked earlier, I answered the question in the chat, but I just wanted to clarify for mass housing, you said that you would take out they would get a second mortgage,
Mhm.
or a second loan on for the down payment. Just clarify that, guys. So it's really your down payment assistance from mass housing will be a loan. So it is money that you do have to pay back. It's not a grant. There are some programs that offer grants, but for mass housing, it is a loan. So they're going to lend you that money and they want you to repay it back. Why? Because they're going to use that money when you pay it back to lend to someone else so that they can buy a home. Okay. So it's kind of like a pay it forward situation.
Mhm. Great. Thanks, Denisha. All right. So what happens if you don't fall into the MHP program or the mass housing program? Um, then we look at conventional financing options, which as first-time home buyers, your income limit might be a little bit higher than the income limit allowed for MHP, which is fine. I mean, you're still going to get a low percentage down of 3% to 5%. There will be private mortgage insurance, typically best for borrowers if you or have a 660 credit score or higher. Gifts, everybody are allowed on all transactions, just so you know. So if you have any family member that wants to give you some funds, that's always going to be allowed. Okay. In some cases, maybe you're just starting or you haven't, your job or whatnot, you might need a non-occupant co-borrower. Non-occupant co-borrower means like maybe your mom or dad are going to co-sign the mortgage and we get to use their current income and such to help you to qualify for the payment because maybe your income right now just doesn't cover it to where we needs to be approved. Conventional financing will allow us to do that. MHP or mass housing will not. It's just for the people, the primary borrowers. There's no non-occupant. Non-occupant means that they're not going to actually live with you in the same house. The two options that are designed for first-time home buyers and come with very much discounted rates and discounted PMI through Fannie and Freddie are called Home Ready and Home Possible. Home Ready is Fannie Mae's version. Home Possible is Freddie Mac. Now, what the heck am I talking about, right? So Fannie Mae and Freddie Mac are the two governing entities of mortgages in the country. They both just come with a little bit different guidelines and a little bit different pricing sometimes. But again, both of these programs are excellent, and I fall to these two. If I can't do if I can't go to MHP, then I'm going to go to mass housing or to one of these programs, because this is where I find typically the best terms available for my buyers. Finally, we have government programs called FHA, VA, and USDA. So if you're talking to a lender and they're just telling you that you only qualify for an FHA mortgage, and they haven't mentioned any of the other options that I've brought up thus far this evening, you need to hang up and move on. I see a lot of first-time home buyers get stuck with a lender that's just throwing them into an FHA loan, which isn't necessarily a bad thing, but FHA comes with some additional costs that other programs do not. So the perks or the details of an FHA loan is you can put down as little as 3.5%. If your credit is not excellent, there may be a reason why I would have to go FHA, because FHA rates doesn't matter if you've got a 620 score or a 740 score, your rate and the mortgage insurance would be the same. Okay. When you're looking at other options, if you have a lower credit score, it could affect the rate, making it higher. It could also have an effect on the mortgage insurance, making that higher. So FHA is a great solution for that. Gifts are allowed. There's no income limits on FHA. It also allows for non-occupant co-signers, and you can purchase up to 4 units. On any residential loan, you can purchase up to 4 units, everybody, if you're considering a multifamily. Anything more than 4 units is no longer a residential property. Then you're going into a commercial property, which we're not going anywhere near. But I do sometimes get a call saying, oh, I want to buy this 5-family, and that's a commercial option. FHA does have a neat option, a renovation. So if you're looking at something and you might need some funds to put towards rehabbing the property, they will offer you funds to help you with this cost. And that's just an additional benefit of the 203K loan. And then not lastly, we've got VA loans. So if you've served for our country, thank you for your service. You do have a benefit through the Veterans Administration. It's a mortgage that comes with 0% down financing. And the rates are very low. And in addition, there's no PMI on this program either. So just something to keep in mind if you have served for our country, or if you have any friends or family members that's also considering buying a home and they're veterans, they would have access to this program.
Awesome. Thank you. Question for you. You
Yeah.
can go to the next slide in the meantime, though. So someone asked in the chat if you can stack down payment assistance, grants or loans with these other products outside of MHP and mass housing.
Yep. Great question. Yes, you can. You can stack grants. You can stack all down payment assistance. So you could take a grant you're receiving from the city of Boston, and you could use that in addition to the mass housing down payment assistance second loan we've talked about. You could add in additional grants. I've had clients, a little bit about myself. I've been working for Leader Bank for 18 years. I've been doing this for 25, but my specialty is first-time home buyers, and I've closed a lot of loans, and I've seen some clients come with over like $100,000 in various grants. Denisha, you've probably seen the same, right?
Yep.
So, I mean, they're out there and you can stack them right up on top of each other.
And I'll say, key when you are interviewing lenders, find out what they know, right? Not all, Kathy knows a lot of the down payment assistance programs because she helps people across the state, so she's well aware. But there are some loan officers who do not know what programs are available. And we're a housing counseling agency, so we counsel people, right? And I've had people who they did their counseling session right before their closing. But what that meant was it was too late for them when they asked the questions to learn about these programs. And I had several people where their lender didn't tell them that the town that they're buying in had down payment assistance. So they missed out on $20,000, $30,000 in down payment assistance because their loan officer didn't know. So when you're interviewing, again, these are questions that you want to ask because you don't want to miss out on these opportunities, right? They're huge, especially when you can stack things, right? So you don't want to miss out on them.
Denisha, you said you have a form that you're going to be sending out to everybody that's here. Okay, so everybody wants to take a look at that form. There are a lot of city-specific grants, so depends on the city. There might be funds available, so you always want to check to see what Denisha has on that list. If you currently live in one of 29 communities for the MHP loan, you currently live in one of these communities. Boston is one of them, and your income's within a certain limit. They're currently giving 2% down payment plus closing costs, and you can buy anywhere in the city. So there's a lot of different things out there, I guess, and working with a lender that has the experience and the knowledge to help you navigate this is definitely key, which is, my next slide. You want to definitely consider a lender's experience, their reputation, the institution, themselves. Don't just pick somebody like an online, the lender that, says they're offering 2%, but they don't have any footprint in the state of Massachusetts. Well, I working with a company that's in Massachusetts, I think you would have best um, the best option or the best way to make sure you're getting all of the programs that are available in the city. But like a national lender, like Rocket Mortgage, for example, they probably don't have access to any of this stuff, and they wouldn't know because you're calling a call center and they're probably in a different state, and they're just gonna say, "Oh, FHA."
Yeah, no, and what she's saying is true. And some programs, their down payment assistance comes at a cost, right? So it doesn't sound like it, but they're charging you points. They're charging you a higher interest rate. So there's
Right.
a trade-off for it, which is why you want to ask questions. It's
Okay.
not free.
All right. So we're at questions. We just kind of did that, right? So then
Mhm.
Denisha wanted me to focus mostly on programs tonight. So I've done that. So then I'm going to go into some more mortgage based stuff like,
Yeah, so now what are you looking for? Because not because I said I want to buy a house means I could buy a house, right? If I
right,
if I have no job, I have a 500 credit score and I have $0 saved, probably not buying it.
probably not. Correct.
Okay.
So what is a mortgage? A mortgage is a loan to finance real estate, allowing payments over time instead of upfront. So when we're looking at mortgages, typically they're 30-year fixed. So that just means that you're buying $400,000. That payment is divided up for 360 payments at a specific principal and interest payment to pay off that loan. Mortgages require monthly payments of principal and interest and are secured. So the mortgage, we're not only looking at you guys as the buyers, we're also looking at the property itself as collateral, of course. Choosing the right mortgage, selecting a mortgage depends on financial situation, credit history, and long-term goals. And the role of a lender is to guide you guys through the loan options, interest rates, and repayment terms so that you can make informed decisions. And what is an anatomy of a mortgage payment? Okay, a mortgage payment breakdown is going to, your mortgage payment's going to have your principal and interest for the loan amount that you've borrowed. It's also going to have property taxes for the property and home insurance. And if there's a condo fee, that will be included in the debt that we qualify you for, and mortgage insurance as well. So that's what your standard mortgage payment will include month to month. So who decides how much you can afford? Is it you or is it me as the lender or the bank? And I always love this question because I think it's really up to both of us. I mean, I might tell you you qualify for X amount and you don't want to spend that much a month, right? Maybe you want to be pre-approved. I always ask that. I pre-approve somebody and then I say, hey, this is what the payment looks like. Is this okay with you? Because if not, then you want to make sure you're looking in a range of property and purchase prices where you're comfortable at the end of the day too. Um, Two terms you might hear as you're working with different lenders. One's called pre-qualification, the other one's called pre-approval. I personally only issue pre-approvals. Pre-qualification typically means that they're not doing a deep dive into your financials. To get a proper pre-approval, you're going to have to do some work. I hate to say it. We're going to need some documents for you. The lender, the bank that you choose will need documents because we know what the guidelines are. We know what the underwriters will be looking for. And when you get a pre-approval or a letter that states, hey, you qualify to purchase a $500,000 house with a 10% down payment or whatever the terms are, you want to be as certain as possible when you give that letter to your real estate agent and they give that letter to the seller of the property when you make offers. So all of these things are very important for your pre-approval. And I think Denisha also said she'll send you a list of standard items that are typically needed, but getting prepared to be pre-approved and saving all of these items, right, into a neat folder in your computer so you can access them easily, I think is the best advice I could ever give somebody. And
Amen.
saving them as a PDF, like a PDF version, don't just take a picture and then have all these different documents, a picture of each page. I see that a lot. Try to save tax returns and PDFs, everything into a PDF, and that will just streamline your pre-approval process for when you're ready for that next step. So items needed, most recent pay stubs for the last 30 days. So if you get paid twice a month, that's 2 pay stubs. 4 times a month, 4 pay stubs. Federal tax returns the last 3 years. W-2s or 1099s the last 3 years. If you're self-employed, they're going to want to see a profit and loss statement so if you're self-employed and now we're in November, we'd want to see a profit and loss statement up until November. Your most recent account statements, 2 months. And I say just do all of your accounts, all of your checking, all of your savings, any of your retirement accounts, any of your investment accounts. On a mortgage, due to 9/11 and the Patriot Act, we have to source all funds in a mortgage transaction. So that's a good thing to know. We're going to need to see if you're transferring funds from one investment account into your checking account. Any bank is going to need to see that paper trail when it comes to approval. All lenders will need to pull your credit. And if you happen to be divorced or separated, or maybe if you're collecting child support, we need to prove that. We'll need a copy of these agreements so that we can prove that that's the money that the court ordered for you to receive or for you to pay. But that is the list of documents that you might need. Is there any questions on that?
I have one. If you guys
Okay.
have questions, please raise your hand or put it in the chat. But what happens if I don't necessarily trust the banks and I save my money at home? So I actually have $30,000 saved in a box in my house. I've had this conversation with people.
That is the way, I don't know how you would respond to that, Tanisha, but what I would say is put it in the account today and then call me in a couple of months so that it's seasoned and it's there. Is that what you would say?
Yes. So
Okay.
guys, if this is you today, you have money in a shoebox in your mattress saved somewhere in your home. It needs to be sourced. Like Kathy just said, everything there needs to be a paper trail, right? The bank looks back 2 months. They just told you two bank statements, right? So if you are going to buy a home in 2026, or if you're planning to buy it next month, you're in 2026 now, you need to put the money in the bank and wait till you have, I guess we would say, three statements to make sure that in the two that you're providing, they see that money in the bank because it's been seasoned. It's in there. Okay. They're not looking back beyond that. So you need to go get that money deposited into your bank account today so you can start your process by, I'm going to say February, March. Okay.
Very good point. Hmm. So, how is a lender going to evaluate you as a home buyer? Okay, we're going to look at your credit history assessment. We're going to look at the credit reports and the scores to evaluate your history of repaying the debts reliably. Okay, the collateral as security. We're going to look at property or assets that serve as collateral, providing security to the lender against the loan amount. We're going to look at capital and financial stability, which is your savings, your assets to demonstrate a financial stability and ability to support the loan commitment. Don't think as first-time home buyers, we're looking for a lot of assets. We are not. A lot of programs, we don't need any, like as long as you have, we'll prove the money that you have to put down, right, for down payment and closing costs. But we're not looking to make sure that you still have 10 or 20 grand saved somewhere. That's not a requirement typically at all on a first-time home buyer program. They just want to see that you have enough money to come to closing to close on the home. Okay. And repayment capacity. We're going to look at your income, your employment history, debt to income ratios to determine your repayment ability. So that comes down to the 4 C's: credit reliability, collateral property, capital savings, and capacity income. So credit reliability, credit score requirements. What is a FICO score? So that's what I was talking about in the beginning, your 3 credit scores. What's good? I mean, it depends on the program and what the program allows. But, anything, above a 640, I think is pretty average. If you can get up to 700 and above, I'd say that's great, but a lot of the first time home buyer programs, as long as you meet the minimum credit requirement, for example, on MHP, that's just a set rate no matter what. So as long as you meet that 640 requirement, you're fine. Once we're starting looking at different options that and how that affects rate, that's when I would maybe look at toggling to different options for people. Because if the credit score is lower and that's going to cause a much higher rate and a much higher PMI, then you want to be able to go into a program that has those items fixed no matter what your credit is, for sure. Because it can get pricey. We're going to look at just, I've had people who've come to me and they only have, maybe you're just started credit, you only have 2 credit scores, or you might not have a credit score. I right now have a client who the wife has a credit score and the husband does not, and we're able to do the loan. So if you don't have a long established history of credit, there could be options out there for you. And we're going to look at the different things, what is affecting the score, your debts, student loans. I'm so sorry for those of you that still have them. It is a big pain in the neck because right now, if you're buying a home and your student loans are in forbearance, lenders have to count a certain percentage of that debt unless you are on what's called an income derived payment plan, which was very popular in our last administration, not so popular with this administration. But if you've got a lot of student loan debts, the best advice I can give to you if you're trying to buy a home is to try to contact the student loan servicer and ask to be put on an income derived payment plan. That way that lender can use that letter and only count whatever's on that letter, including if it's a 0. So that might be helpful to some of you out there that might have hundreds of thousands of dollars of student loan debt, which I do see at least, I would say, once a week. So Um, Understanding FICO scores. I've never seen a FICO score 300. I've never seen a credit score of 850 either. So usually I see anywhere between somewhere in the 500s to the low 800s is what I've seen. The influencing factors are your payment history. So, I mean, just do your best to make all your payments on time. Amounts owed is an interesting, right? So if you have, let's just say you have a $5,000 credit card with the limit of $5,000, that's the max. To keep your credit in the good range, you might want to just keep your balance at like, only 2,500 versus having it at 5,000 each month, because that does have a negative effect on your credit score. Length of history is another very important factor. So I like to tell clients that are thinking of buying a home, if you've got those credit cards and then you've got an offer to transfer those balances to a 0%, don't ever close out any credit lines because history is a good factor. So take whatever that credit card is you don't want to use anymore and put it in your jewelry box. Just don't use it.
I agree. Can I interject there?
Yes, you can.
So Kathy was being kind to you guys earlier. So those of you who know me know I'm a straight shooter. So she said, please try to pay your bills on time. It's not a try. You must pay your bills on time because one late payment that's actually reported as late, there's you miss the due date and they charge you a late fee. Not that. It's once you're 30 days late and they report to the credit bureaus, that can drop you 50 or more points. One late payment. And it's not going to be the next payment that you make on time. It erases that. One bad deed can stay on for a year or more. So pay anything that shows up on your credit report and you are trying to buy a home, they get paid first because the damage that it does because you missed that or you were late on that payment, it derails the process for a long time. So prioritize paying whatever shows up on your credit report first. So that's your student loans, that's your car payment, that's your credit cards, that's any personal loans that you have. I'm trying to think, I think that's everything. If you miss those or you're late on those, it is detrimental to your credit score. Kathy also said try to make sure you keep your limits low. So if you have $1,000 credit card, ideally you want to have less than $300 on that card reporting every month. So that's a 30% utilization. Above that, you see your score start to drop. Okay. So if you have higher, as you pay it down, your score will increase. But we see the greatest increases or boosts in your credit at 30% and then at 10% of whatever that limit is. Okay. So as you're thinking, for those of you who need to work on your credit, pay on time and then keep your limits low. Okay. Just focus on paying down the debt, which this is the season where we start to increase the debt. Please don't do that. And sidebar, can you talk about Afterpay and Klarna? Because that's about to get a lot of people in trouble.
I don't know what you're talking about. What do you mean?
Because those I heard are showing up on credit reports now also. So if you have a bunch of buy now, pay later, each one
Okay.
of those, it starts to report on your credit as a debt. So it's going to ruin your
Oh,
debt to income
interesting.
ratio.
See, I'm learning something tonight too, Anisha. Thank you. So this is just a fun little chart that we were just talking about. So very applicable to what we just talked about.
Yep.
This
Take
is
a
how
photo of
your
the
credit
screen,
score,
guys.
how your credit score is broken down, right? So that payment history, like I said, do not, even if you got a credit card, that you don't use at all anymore, don't close it out. So 35% is payment history. Um, 30% is amounts owed, credit history 15%, 10% new credit, 10% type of credit. So that's just just an interesting chart for you guys to see. Take a picture, or I can send this to you too, Denisha, and you can include it with your stuff if you like. So the other piece, very important piece to any institution that's going to be giving you $500,000, I'll keep with that same, to buy a house, right? We're going to look at the house itself. And the way we look at that is we order what's called an appraisal. The appraisal is always ordered by a third party appraiser that doesn't work for the bank. This is compliance, so that when they're going out, they're not being influenced by anybody on what the actual value of the property is. They're going to legitimately compare the property that you're buying to other properties in the same neighborhood, direct same area that are similar in size, bedroom count, so that when you are buying this $500,000 home, we're getting an appraisal that's telling us that it's also worth $500,000. So we know that nobody's overpaying for a property. Or yeah. Um, so that's that. And there's other things that are ordered with the property. We're going to order a title from the attorney's office, which is just going to run down any liens. As when you buy a property, you become owner of the property, which means if there's any liens or anything like that, you want to make sure all of that stuff is completely taken care of. So you're getting the title clean and clear to yourself. So that's why we hire an attorney's office in the state of Massachusetts to do this research, to make sure we have title and that everything is good to go for when you become the owner. All the taxes are paid. So again, I just talked about the appraisal. It's going to look at the property's condition. It's going to look at recent comparable sales. Like we can't look at get an appraisal and look at the property that you're buying today for $500,000 and say, oh, 2 years ago, a house next door sold for $500,000. It has to be a recent sale within the last couple of months because markets change, everybody, you know? Sometimes the markets could be softening, which might be kind of happening a little bit now. I do see a lot of offers coming in under asking. It
Mm-hmm.
could be switching more to a favorable buyer's market.
It's
So
softening a little bit. It's
your
softening.
timing's great. It's been kind of the wild, wild west, I've liked to call it. The last couple of years, it's been very competitive. Not a lot of inventory. Everybody's got those 3% rates we saw during COVID, and nobody wants to let go of that. But I think people are starting to realize that, you know, they've got to move. They've got to move up, they've got to move down, and we're expecting a lot more inventory in 2026, or at least the experts are. I don't know for sure, but that's what I'm reading. um, we're going to look at your savings and acceptable savings, which we've kind of touched upon: savings, checking, CDs, stocks, gifts, 401k. Unacceptable savings: mystery cash, unverifiable funds, borrowed funds. You also can't borrow funds. So if you are borrowing $10,000 from your brother to buy a home, you're going to pay him back later. Your brother, for the institution, lender, bank, whomever you're working with purpose, it's a gift. They have to source everything. So nobody's looking at this later in the process after you close. But again, due to the Patriot Act and 9/11, all funds need to be sourced. So we can't accept cash. We can't have borrowed funds. Um, we can't have unverifiable funds. I have a client right now whose sister came from Turkey last month or 2 months ago. No, I'm sorry, 3 months ago. And I've been working with him for a year and a half as we've been going through trying to find a home and whatnot. And so I just asked for updated statements, and she gave him $30,000 cash.
Gotta
And
love.
thank God it was 3 months ago. So now I can only get the 2 months, right, everybody? And not show that $30,000 gift, even though we need to use that to qualify. So thank goodness he didn't find his house or his offer wasn't accepted last month,
Right.
because
That's exactly. And in the chat, someone asked how much, is there a limit to how much you can get for a gift?
no, no limit. No, no problem there as long as we can source it, right? We're going to want to see a copy of the check, cleared check, or the wire identifying. Another quick side note. I don't know if Denisha's going to get mad at me right now. She might. Gifts have to come from relatives. They cannot come from your friends. I always like to say we're all cousins and related in some way, shape, or form. just ahead, I can't tell you how many gifts over the last 20 years I've gotten. And it's like, friend, I'm like, no, we can't use that. And again, these are just some silly guidelines we have to follow. But just keep these things in mind. Your savings will cover down payment, closing costs, prepaid exemption expenses, and reserves. Income, we're going to look at your income history. Okay. 2 years, we're going to go back 2 years. What if you just started your job 6 months ago? That's fine. Okay. What if you took 6 months off? You were working, you took 6 months off to have a baby or whatnot. We're going to just want to know why you did that. We're going to look at your full-time income, 40 hours a week, whatever that is, or salary. We're going to take your hourly rate, multiply that by 40 hours a week if you're an hourly paid borrower. If you have fluctuating hours, right, we're going to take an average of what that income is over the last 12 months. If you're self-employed, we're going to look at your last 2 years tax returns for the business or your personal tax returns, your Schedule C. Different things that count. We can count bonus and commission. If you guys are all first-time home buyers likely, so we don't have any rental income just yet. But if you're buying a home that has another unit, we get to count rental income towards qualifying, which is interesting. So you will likely qualify for a higher purchase price because you have higher income from the other units on a multifamily than you would if you were just buying a single family or condominium. Social Security, pension, retirement, alimony, all of these things count towards capacity, aka income. And if you have a co-buyer or co-signer, we can count their income too as well, as long as the program allows for it. Looks like Sharetta has a question.
You should be able to unmute your mic, Shredda.
Oh, hi. So,
Hi.
hi. Back to the gift. Is it true that if they have a wedding or something like that, and they give them gifts, funds, like I guess a gift from a wedding, like a gift, that gift, would that qualify for your gift fund, or are you allowed to
Yeah,
use that?
so that is a great question. I have seen
Mm,
that. Again, I've been doing
okay.
this a long time. I can't say everything. So in that case, you know what I did? We got a copy of the wedding invitation.
Okay.
And
Mhm,
we did. And that
mhm,
worked in that case because they did deposit a large amount of money and we were
mhm,
able to source it by showing that their wedding was that day.
okay. All right. Perfect.
So that
Thanks.
is acceptable though. Great question.
That's a great question. And I think there are actually a
Mhm,
lot of platforms now or more of them available where it's specific where
mhm,
guests can gift you funds. So they collect it all in
mhm,
one account.
mhm,
So that might be an option if anyone's getting married so that it's easier to source because now it's all set
mhm.
up for that purpose.
Gotcha. Okay. Thanks.
Mhm. So yeah, so when we're looking at qualifying, right, you to buy a home, we're going to look at the principal, interest, taxes, and insurance, and a condo fee and mortgage insurance. We're going to look at that total payment, right? And we're going to compare that to your monthly gross income. All lenders will go off of your gross monthly income, not after taxes. They'll take into consideration any of the other minimum debts that are reporting on your credit report. And all programs will only allow you to go up to a certain percentage, otherwise known as debt to income. Um, so if you have monthly income of $10,000, for an example, your total payments, including your mortgage payment, which again comprises of principal and interest, taxes and insurance, condo fee, if applicable, and mortgage insurance, if applicable, plus any other debts. So let's just say you have $1,000 in other debts, and the program allows us to go to a 50% debt to income ratio. Now, on these special Massachusetts programs I've talked about earlier tonight, they're a little bit more strict on how high we can go to debt to income as they are giving discounted rates, grants, all of that. Those debt to income restrictions can be a little bit more conservative, but just for the example I'm giving now, I'm just using 50% because a lot of the programs will allow us to go up to that. So your total mortgage payment cannot be more than $4,000. That's what a lender is going to approve you, assuming you've got $1,000 in other minimum debt payments. So again, just to keep numbers simple, if you make $10,000 a month and the program allows us to go to 50%, then our total monthly debts cannot be more than $5,000. And if we're paying $1,000 in other student loan, car loan, whatever payments, then the max you'd be approved for a mortgage payment, including all of the items I've just mentioned, would only be $4,000.
Yes. I just want to add to that, guys. So because someone's asked this before, let's assume now, as opposed to $1,000, you have $2,000 in other debt. Now that means you only have $3,000 that can go towards your housing cost, right? So the more other debt you have, credit card, car payments, student loans, personal loans, the more of that you have, the less house you can afford. So you're just going to decrease your purchasing power. It's not that you're not going to get pre-approved. It's just you're going to get pre-approved for less. The bank is never going to risk their money. So they have a calculation and they say if you have so much debt, then we're not comfortable with lending you more for this house. We want to make sure you can pay us back. Okay, so that's where they come up with those numbers. So if you have more debt, you can afford less house, which is why we spend a lot of time trying to help you guys pay down the debt so you can afford more house. Okay.
Well put, Denisha. So shopping for a mortgage, comparing like mortgages will have different rates, different, you might see an application fee, points. We're going to go a little bit more into that in just a second. Again, we've talked about each program has different down payment requirements. I think this is customizable to every single buyer, right? It depends on what you have available to put towards this transaction. What type of grants may or may not be applicable? What programs are the best fit for you? So there's a lot of navigating that I believe a lender needs to do on your behalf to help you to figure out what the best program is. This is just a fun timeline. I can send this to you, Denisha, too. Like, what does it look like? First you want to get pre-approved. Well, that's a necessity because you need a pre-approval letter to make offers. Then you make your offer, okay? Then the offer is accepted. Then you can do a home inspection. Great. Massachusetts just made this legal a month ago where you can have home inspections again. Did you know that, Denisha?
Say that again.
I said, so for a while in this wild West market
I know.
they've been waiving all sorts of, so to get your offer accepted in some cases, you had to waive your home inspection contingency. As of October 15th, 2025,
You can no longer do
the
that.
National Association of Realtors have come in and they've made it illegal for a seller to accept an offer above and beyond another offer that waives home inspection. So very good stuff for you guys, I think.
Yeah, I think again, reinforcing why home inspection, someone asked earlier, why would a seller, kind of say they're eager to sell? And sometimes it's because they need to move, like they might have a life emergency, so they need to sell quickly, they need the cash. But some sellers are, unscrupulous a little bit, and they know there are issues with the property, and they're trying to get you to pay for all those things. So they're trying to sell before they know something's going to go wrong. And that's why you get the home inspection to make sure you're not getting into something and you're going to be over your head.
Mm-hmm. So then once you have your home inspection, then you move to the next steps of finalizing your application with your institution, just in case, the home inspection does bring to light items that you are not comfortable in moving forward with as becoming the homeowner. You might not want to be responsible to rectify pest damage, mold, all sorts of different things that could come up. So you lock in your interest rate. You will sign your purchase and sale. Again, a lot of the stuff's probably covered in Denisha's 8-hour classes. You during this process, the lender will order the appraisal I talked about. We're going to order the title from your attorney's office, making sure all of these items are good, right, for you. And once we have all of these items, there might be additional items that need to be collected from you. If you got pre-approved 3 months ago, the lender might need updated pay stubs or updated bank statements. At that stage, once the underwriters looked at all of these items, have signed off on your income, your assets, the appraisal, the title, then they will be in position to issue what's called a commitment letter. A commitment is exactly what it sounds like. It is the institution, bank, lender, whomever you're working with, commitment to you that you can buy the $500,000 house and we're going to give you whatever loan amount. Let's just say you applied for a $450,000 mortgage. Your commitment letter is your guarantee that you're going to get the loan. That is shared with the seller's side, and then they schedule your closing. So, important forms, your application's called a 1003. Once you have gone into process with a lender, they're required to issue you what's called a loan estimate, okay? The commitment letter is something that's issued typically 2 to 3 to 4 weeks within process. Again, that's the guarantee that the institution's going to give you the mortgage. And then you will receive what's called a closing disclosure, CD, 4 business days at minimum prior to your closing that have your final figures on it. Unfortunately, some of these forms were not regulated, and I was a part of that because I've been doing this a very, very long time. But the Consumer Finance Protection Bureau stepped in. I can't tell you how many years ago, maybe it's been 7, I don't know. They made a lot of these forms required. So the closing disclosure that has your final figures on it has to be released to you 4 days before closing, so that when you go to closing, you know that your fees are what they are, that they're not going to change, that you know what you're bringing to closing. Because what was happening is these forms were not mandatory at all. They didn't exist. And clients were getting to closings and they were realizing that there were a lot more hidden fees that weren't supposed to be there, or they didn't realize. And then they would have to, if you wanted to buy the house, you had to sign the forms and close, and it didn't matter. So that can no longer happen. You're protected as a consumer because of these forms that they've put into place. Some more mortgage application. Once you have your accepted offer, you're going to be submitting your mortgage application into processing, which allows us again to do the commitment. To do the title work, the appraisal work, the underwriting, and the commitment letter I've already gone over. Understanding loan terms and comparing options.
I think we talked about those already.
Okay, we can move on. So fixed rate mortgage, that's going to be the most likely what you will end up with as a first time home buyer. And that's a lot of the grants won't even give you a grant if it's an
Correct.
ARM. So,
And I don't like it. So again, I'll say
Denisha won't let you get
I
one,
won't,
so
I
that's
won't.
okay.
Yeah, I won't even if you do a counseling session with us and say no.
Yeah.
These are
So fixed,
adjustable rate mortgages are for specific buyers. Most first time home
yeah,
buyers don't fit that category. I had someone, again, this is why I say interview lenders. He had a home under agreement and he just was calling agencies to find out if we knew of other lenders. Just on a whim, I'm like, I'm so glad you called because his lender had him in an adjustable rate mortgage as a first-time home buyer. He was buying in the city of Everett. And I was like, well, first of all, we're not using that adjustable rate. So we're going to go back and check. Did the income questions, qualifiers, he qualified for the one mortgage, but his lender did not have it, which is why they did not let him know. And they did not let him know that he was eligible for $20,000 in down payment assistance from the city of Everett. So we don't like adjustable rate because you're going to forget to refinance and get out of it in the future, and life happens, and it could be where the market's higher than when you bought and get yourself in trouble. So we don't do those. And you need lenders who are knowledgeable of all programs so that you can compare everything and pick what's best for you, not what's best for them. In that case, that lender was absolutely picking what was best for the lender and not what was best for the client.
So
Can't
yeah, fixed rate is exactly adjustable rate, just means it's fixed for a short period of time. That's why Denisha and most clients are not even open to them because they just want to know that they're going to have a fixed rate for the next 30 years. You can always refinance your mortgage, everybody. So if you locked in today at a rate of 6%, just for an example, and 2 years from now, the rates go to 5%, you can always refinance into a lower rate on a 30-year fixed. So you can, some clients in my career, when we start to enter a downward trending rate environment, I've refinanced some clients 4 and 5 times over the course of a 5-year span, just because the rates cooperated, each time getting, the lower payment for the client. We've gone over loan estimate and CD. Interest rate versus APR. You want me to do that, Denisha, real quick?
You can. What's the difference between interest rate and APR? I think a lot of people, they don't know.
Yeah. So, and I get this question all the time. So I think it's definitely important to touch upon it tonight. The interest rate that you receive is the interest rate that you're paying back the loan amount that you're borrowing from your bank. So if the interest rate is 6%, you're paying that on the $450,000, just using the example I used earlier, right? But when you're looking at and you're comparing, if you're looking and you're talking to a couple different banks and you're comparing terms, it is the bank's responsibility to not only list what your interest rate is, but you'll also see something called APR. Okay. You'll also see APR on all of the documents you receive once you get into disclosures. The APR, annual percentage rate, is always a little bit higher or a lot a bit higher than your interest rate that you're paying. So your interest rate that you're paying in the example I just gave is 6%, and that's your 30-year fixed, and that's what your payment's going to be. But then you see an APR of 6.125. The APR is taking into consideration the closing costs for the loan and annualizing it, and then comparing it to the rate that you've gotten. So APR became something that the banks had to issue many years ago, actually before my time, I'm pretty sure. What was happening is, we didn't have, or buyers didn't have access to as much technology as we did today, right? So when they were calling various banks, they were just calling, what's your rate? What's your rate? So one bank would tell them my rate's 6%, and the other bank would say 6%. But if you asked for the APR, and the APR with one bank is 6.5%, and the other banks is only 6.125%, you know that the closing costs are a lot higher because the APR is a lot higher. So that's where APR comes from. But so many people ask me the question because they see the APR and they think that that's the rate that they're paying on the money that they're borrowing. And that's not the case. It is purely a tool so that you can compare different options. In today's technology, when you're comparing things and you get quotes, you'll always see an APR. And well, I always provide the breakdown of the costs anyways. But if you see a higher APR, then you know that there's points. So for example, if you're driving and you hear more, I don't hear them as much as I used to, but a mortgage, oh, we're offering a rate of 5%. And then you'll hear really at the end of it with an APR of 7%. Like, that they're charging a lot of costs to get to that rate. Another quick thing, loan points. I don't necessarily advocate for paying points as first-time home buyers because there's likely a very great opportunity. You'll be refinancing the next couple of years if you were to buy a house today, because we are in a higher rate environment to what I've seen historically over the last 25 years. But you can pay points to get a lower interest rate. Typically 1 point equals a 0.25% discount. So going back to my 6% example, if you paid a point on my $450,000 loan amount, that would be $4,500, and it might give you a 5.75% rate, just a 0.25% discount. So that $4,500 gets you only a 0.25% discount. And every single time I've done it, it's a break even of like 7 years. And the likelihood of you keeping that mortgage for 7 years is really not that high. Refinancing will definitely become an opportunity, or maybe you move on to a different property. But my point to all of you as first-time home buyers, and as you're starting your process and working with lenders, if you see points on any breakdown without a very good reason why, move on to another lender. I've had first-time home buyers come to me in tears saying, I just don't have $30,000 to pay for closing costs. And I say, I've never seen $30,000 in closing costs. It's because that particular institution was charging points. And a lot of institutions will just automatically put 1 to 2 points. And if you don't know better, because we're teaching you right now, you will know better. You shouldn't see points on any on any breakdown as a first-time home buyer. And, you know, again, I don't even advocate for people that have owned homes. Like, why pay points? Because the break-even analysis is 7 years, and the likelihood of being in a home for more than that or keeping the mortgage for that time frame is very slim. So now you guys know about points.
Thank you. Hopefully, you guys, any questions with that? Hopefully that made sense to you. So there are enough programs in Massachusetts where you should not need to pay points. Usually you'll see those with a lot of lenders who are national. So they're coming in, they don't have a lot of like mass housing or MHP to offer. So they charge you points to make things, to make the numbers work.
And they're also probably, you know, they're giving you a teaser rate saying, oh, the rate's only 5.5, but they're buying down that rate with 2 points, which 2 points on a $450,000 loan is $9,000 added to your closing costs. We got better things to do with our money. We got to buy furniture.
Pay the movers. We got money.
We got to pay.
I'll let you go over this slide and then we'll see what else is on there. So I do have a question in the comments that I think we might spend.
We just have 2 more slides, so then we'll be done. We'll be wrapped up. So closing costs versus prepaids. So closing costs are one-time fee, everybody. Like, you have to pay, usually the institution, some sort of processing fee, right? You have to pay the settlement or the attorney's office. Massachusetts is an attorney state, so we have to close with attorneys, which is I actually like that better. I mean, if you're in New Hampshire, you actually don't need an attorney whatsoever. They just have these title companies. But these fees are a one-time cost associated with closing the loan. You'll also see other breakdowns on when you get a breakdown from a lender that say prepaids and escrows. So your prepaids, when you become a homeowner, the easiest way I like to explain it is you are now responsible for that property's tax and insurance. These are prepaid expenses that they are collecting at time of closing. They're going to collect for a year up front for home insurance, okay, because you always pay home insurance a year in advance, and they're going to collect whatever tax bill is due at the time when you close. In addition, they're going to collect a couple months of each to put in this account called an escrow account for you guys. So when these bills come due in the future, the loan servicer will be paying these bills for you. It's one less thing to worry about, but these are also included in any sort of closing cost breakdown you're going to receive from a lender: prepaids, escrows, and closing costs. So you now know a little bit more about that when you see it. And common mistakes to avoid during the loan process: avoid job changes. It is not the end of the world, everyone. If you are working at a company and you got pre-approved and you got a better offer somewhere else, again, as long as I can see that, hey, you now got this job. I mean, it's in the same type of industry, it's a similar salary and all of that stuff, it's fine. But don't switch jobs and not tell your lender. I have literally got to the day before closing, and all lenders have to do a verification of employment just to confirm that you work there within 10 days of closing. And I had a client who switched jobs and didn't tell me. So you just want to make sure that you are upfront with your lender if you have any sort of changes in jobs. Manage credit carefully. Don't go on shopping sprees until, well, maybe not even after you own a house. I don't know what Denisha will tell you on that one. But manage your credit. Make sure you make all of your payments. Do not open a ton of different accounts. Just keep what you have, make your payments, keep your balances low. Transparent financial to provide full, accurate documentation to avoid large and unexplained deposits to build lender trust. And you want to submit documents promptly and maintain open communication with your lender to prevent delays. And that really kind of wraps up what I had prepared for this evening. So on that note,
Yes. So the question, thank you very much. I learned a lot. Hope you guys learned a lot also. The question in the chat was, do you need to have, because you just talked about it a little bit, 2 years of full-time work history, or just 2 years of work history?
2 years
Define
of
2 years of employment. What does that mean?
So it just depends on what you've been doing and what your income looks like. There's never a 2-year requirement. We're going to look back for 2 years to see what you've been up to. What if you just graduated college last month and you just started your job yesterday? That's absolutely fine if we can show that you were in school beforehand. If you started working, so there is a concern there. So if you started working, you were a full-time employee, you were making a salary, then you switched to a part-time job, and that's what you're currently working. We can't look back to that full-time job salary that you were making a year ago. We're going to go off of what you're making today. So if you've just started working full-time, if it's a salaried position, everybody, as long as we can show a copy of your offer letter, we'll be able to use that for qualifying purposes. If you've just started a new job, it's hourly. They're going to want at least 6 months history at that job.
So I have a
Denise, you
question.
have anything to add?
Oh, I have questions now because I have also heard you need 2 years in the same field. So you can be a teacher and switch schools, and that's fine. But if you were a teacher and now you left because you're burnt out, you don't feel appreciated, you've left education,
Yeah.
and now you want to be a loan officer, for example.
In
Now
that
that's
case,
a
you
whole
are
different
correct.
career, and you need
Right.
2 years in that career, not because you just switched, but you just made it sound like it's not.
I haven't seen that myself. So is if you're on a salaried, if it's a new career for you, if you've got at least 6 to 12 months into that career, depending on how you're paid. If you're paid hourly, they're going to want to see a 12-month look back period. If it's a salaried job and it's completely different, then they're going to ask for 6 months, Denisha, in my experience.
Okay.
So, I mean, it's good to have 2 years, but I've gotten around it so many times. So I
See,
just, I
you
don't,
talk
and
to
if you
different
have
lenders, you
questions
hear
about
what
it,
they can do. So some lenders have more leeway, some do not. Because I always
right.
ask, and some lenders like they need 2 years, and someone like I just switched jobs. Like, well, now we need 2 years of work history. Come back
Yeah.
in a year and a half, and let's try this again.
Calling a lender and just going, if you have any concerns like this and going over your scenario, they should be able to answer your questions if you just give them a breakdown. And if anybody starts saying they need to pull your credit and they need all the documents and you just want your basic questions answered, hang up and move to somebody else because you don't
Yep,
need to deal with that at all.
correct.
Somebody with experience should be able to navigate your high level. Like I will talk to a client and just ask what your income is, what's your history and all of that. And I can easily say, I think this might be a good fit for you. This might not be a good fit for you. You should be able to communicate with a lender in that regard so that you have an idea that, hey, this might work for me at this point. This might not work. Again, what might I need to work on to become mortgage ready so that I'm ready next year or 2027, whatever that is. Again, if they start asking you for documents and they want you to submit an application and pull your credit, hang up and move on to the next one.
Amen. I agree.
Mm-hmm.
Okay, guys. So thank you, Kathy, for a very informative session. Guys, I want you, if you have any questions, you can raise your hand and unmute, or if you want to put it in the chat, that's fine. I'll ask the question out loud for you. Awesome. I'm glad we're able to speed up your timeline. Perfect. Okay, so it doesn't look like we have any more questions. So I will say thank you, Kathy. We are going to, let me stop the recording. Hold on.